I'd like to thank everybody for joining me today. Today, I want to talk about our options for long-term care with our clients. How do we help them overcome this long-term care need that the majority of them will most likely have in their lifetime? And so understanding our options that are available to us are going to help us in the planning process with our clients. When you look at long-term care involves around being able to continue our life that we're used to. So there's 6 activities of daily living. If you can't do 2 out of the 6 activities of daily living, or you have a cognitive impairment, you're going to be able to trigger that long-term care policy. So understand, we're trying to help our clients to be able to continue to do the things that they do every day and in the most efficient way. And when you can't do that, now you're going to need help in the long-term care. As you look at long-term care is such a big need out there. Part of it comes down to how are we going to pay for that long-term care? Most people, I hear this from a lot of people. I'm going to self-insure, or really you're going to self-pay. You're going to use your own money. You're going to pull out your checkbook and you're going to write a check for all those payments. Now, understand that if you're using your retirement account, which a lot of people look at, you're going to have to gross that up and pay the tax so that you can use after-tax money to pay your long-term care bills. That's going to create a cash flow crisis that most people haven't planned for. If you don't have any money or don't have any assets to protect, there's government programs like Medi-Cal and Medicaid. What I like looking at is long-term care insurance, transferring that risk to the insurance company and leveraging our benefits so that it's not a dollar for dollar payment. Now, with this, we need to help our clients understand what their long-term care insurance options are going to be. So we're going to look through a few of these. The first one I want to look at if we have a single life and it's long-term care focused. With this, with long-term care, we have a 62-year-old male, and in this situation, they want to focus on their care. And if you look at this at age 62, they've got a benefit that will pay $5,000 a month for a total pool of benefit of $387,000. Now, if you go out to age 75, when they'll most likely start potentially needing the care, there's just shy of $7,000 a month of benefit and a $527,000 pool of benefit. This is guaranteed. This is guaranteed, so we don't have to worry about, well, what if the economy, crumbles or whatever. We've got guaranteed numbers here. What I like when we do this is we've got to focus on the other part. Is this affordable for our client? In this case, we're going to pay $9,908 a year for 10 years. That's it. The payments are done. It's fully funded, and we don't have to worry about now our client has this long-term care bucket. If they were to need it, they can turn that on when they can't do the 2 out of 6 activities of daily living or they have a cognitive impairment. If they don't ever use the benefit, this isn't like the old traditional use it or lose it long-term care. These hybrid policies or linked benefit policies, this has a death benefit that will pay to this client's heirs. If he doesn't ever use the benefit, they're going to get a death benefit of $120,000, which is a little more than the maximum that they could pay into this policy. Now, if we have a husband and wife or we have partners that we need to do a joint life, and there again, we want to stay care focused, we can go to a policy that handles a joint life. So now we have a 62-year-old male and a 54-year-old female. This policy will pay out $5,564 a month, and they could be on claim at the same time. Here's what I like about this policy. It's not a pool of money. It's an unlimited benefit. So if they're on claim for 20 years, 30 years or more, this will continue to pay as long as they're alive and as long as they're qualifying for those benefits. Now you look at the premium that goes into this. This doubles the premium on this particular client. Instead of paying for 10 years, they'll pay over 20 years. And that's the total premium they'll ever have to put into the policy, guaranteed. Now, there again, it's not use it or lose it. We've got a death benefit, $139,000. If they fully pay this out over the 20 years, they're not getting a full reimbursement of everything they paid. But there again, it's a good payment back if the benefit's never used. So there again, looking at it, what type of benefit are we trying to provide, how much cost, and then we want to look at what if they never use it, what is that what if payment back. Now let's start looking at this. What if we have a client that would love to cover their long-term care, but they're also looking at all of their other planning objectives. Maybe they need family protection. Maybe they want that what if bucket, for retirement money, just in case they run short on cash. And of course, we're talking long-term care. They see that that need is there and they want to make sure that part is covered as well. So with this case, we can go to a life insurance policy. Instead of being care focused, now we're going to switch over to a life insurance policy and add the care benefit along. So let's look at this for a guaranteed policy. With this guaranteed policy, what I looked at is, let's jump forward. They're going to have a death benefit guaranteed of $500,000. This $500,000 of death benefit is going to be there if they pass away. This is a benefit that's going to go to their named beneficiaries, take care of them for what they need. But now let's start looking at that what if. There again, think of Swiss Army knife of planning. We're trying to cover multiple objectives, multiple planning, ideas that need to be covered, and we've got limited, premium that we can put in. In this case, now we've got the death benefit if they need it. Now we have a growing cash surrender value. If they need this cash surrender value in retirement or anywhere along the way, they can take a withdrawal, they can take a loan, but it provides them that what if benefit of what if I need cash? What if I need cash to take care of myself today or take care of my family today? We've got access to that. Now you start looking at, okay, what about the care need? And in this case, you can look at either a chronic illness rider or you can look at a long-term care rider. In this case, this policy, we're looking at a chronic illness rider. There again, in the what if scenario. What I like about a chronic illness rider, there's no cost for that benefit when you're paying for the policy. It's not included in the premium as an additional charge. It's only going to be a cost if you access that benefit. So if you get to that long-term care situation, you need long-term care benefits. Now there's going to be an acceleration of the death benefit to pay for your long-term care. There's going to be a cost for that chronic illness rider at the time you've exercised this benefit. There again, looking at the activities of daily living, if you can't do 2 out of 6 activities of daily living or having a cognitive impairment, look at what this policy can do. At age 75, there's a maximum annual payment that can come out for chronic illness, $80,149 a year. And at age 80, that goes up to $90,349. That'll be for about 4.5 years of benefit. So there again, what if? What if our client needs that benefit? What if they go into a long-term care situation and now we needed that benefit? What's most important at that time? Possibly the long-term care. Or they can say, you know what, we've got the ability to pay for the long-term care. Let's keep the death benefit, and they can always access cash value. So they're again trying to do the Swiss Army knife of planning. If our client wants more security in the long-term care side, they can add a long-term care rider instead of the chronic illness rider. There again, with a long-term care rider, they're paying for this benefit up front, and we've got that ability to access it, without an additional cost at the time they exercise the benefit. So where are we at? The big question, big part of this is you need to help your clients plan. You need to work with your client to understand their needs, their goals, their objectives, their financial situation, so you can fit the policy that they need for long-term care, whether it's a hybrid long-term care policy, whether it's a rider to a life insurance policy. We can get into an option that will be their best fit and help them to overcome this need. There again, the vast majority of us are going to need some kind of long-term care benefit. We've got solutions. We just need to help our clients through that. So if you have questions, feel free to reach out. If not, we'll talk again next week. Thank you.